No one outside of this stupid little bubble that we have cares at all about which blockchain you're running on. They don't care if it's decentralized. They don't care if it's permissionless. They don't care if it has rollups or blobs or anything. They just care that they can use it.
Hey everyone, welcome to the Smart Economy podcast, where we ask your favorite builders the questions you wish you could ask yourself. This is a production of neonewstoday.com, and I'm your host, Dylan Grabowski. In today's episode, we're joined by Greg Di Prisco, the co-founder and chief architect at M0’s, a developer entity focused on simplifying cross-chain stablecoin interoperability. In this conversation, we discussed Greg's background at MakerDAO and his early attempts at launching an Ethereum ETF, abstracting complexity away from stablecoin offerings and issuance, why he prefers the Genius Act over the Stable Act going through Congress right now, how cutting-edge blockchain companies will outcompete the banks, and so much more. Just a reminder, nothing said in this podcast is a solicitation to buy or sell any tokens, and that the host or guest might hold tokens discussed in any given episode. You can see a disclaimer at neonewstoday.com. If you enjoyed this episode, please rate and review it on your favorite podcasting platform and share it with your friends and family. Every rate, review, like, and comment helps us reach more people and bring you more of your favorite guests. With all that said, I really enjoyed chatting with Greg, and I hope you enjoy the conversation too. Hey everyone, welcome to the Smart Economy podcast. Today we're joined by Greg Di Prisco, the co-founder and chief architect at M0’s, a developer entity behind the universal platform powering builders of application-specific stablecoins. How's it going today, Greg?
Good. Thanks for having me, Dylan. It's not supposed to be that much of a mouthful when you say it, but we might have to revisit that one.
Well, there's always opportunity for SEO improvements, but I think the mouthful is a nice kind of segue into the interesting topic of the kind of like orchestration and cross-chain utilization that M0 is really going after that I can't wait to dig into. But I kind of want to start maybe like high level first, and then we'll talk about the stablecoin outlook in general, and then really hone in on M0. So before we dig into even your Genesis story, can you share a little bit more about how your career started as a futures trader?
Sure. I don't get that one every day. Well, so I always wanted to be a trader, believe it or not. And most kids are like, I want to be a firefighter or some sort of normal job. I always wanted to be a trader. I think I got my first trading account, like one of those currency trading accounts, when I was like 12 or 13 or something. It was when they just came out, and I loved it, got hooked. And then when I went to college, I studied economics and finance with the intention of leaving and being a trader. And I left and became a trader. But this is kind of segues into my Genesis story. So in my senior year of college, which was still 2010, I guess, I had gotten interested in Bitcoin because I was very interested in economics, very interested in trading. And at the time, I don't know what you were doing during the great financial crisis, but we all thought that everything was going to collapse and the dollar was worthless and we needed an immediate alternative store of value that could be transported across borders and things like that. And on the libertarian internet forums I was in at the time, they were all talking about Bitcoin. So I got interested at the time. I bought a little bit, obviously not a lot. And I think I lost that original one anyway, but that got me hooked on crypto. So even though I went into trading for the next 6 years, I had like one foot in the trading world and one foot in the crypto world because I was constantly paying attention to the development in the space.
Yeah, even though you probably didn't buy like hundreds or even tens of Bitcoin, it sounds like you had to go through the first experience of like downloading the wallet, and it sounded very cumbersome back then. So being I guess calling you a Bitcoin OG.
I wouldn't call myself that. There's a lot more real people who didn't just buy it and forget about it for 6 years.
Yeah, well, I guess maybe because that kind of include like your user experience is valuable, especially back then. So,
well, my favorite thing about that is how I onboarded to Bitcoin.
Okay.
Which because I didn't trust anybody. There was no exchange at the time. And I was on a college issued laptop. I wasn't going to be mining anything even back then. So I had to find a guy on PayPal that would take like PayPal and send me Bitcoin in return. But neither of us trusted each other. I still don't know who the guy was, but neither of us trusted each other enough to actually deliver the full shipment in one go. So we did it where I was like, what's the maximum amount I'm willing to lose on this guy? So I'd send him $10 and he'd send me $10 of Bitcoin. And we did this like over and over until the final, I think I sent him the final 10 and then I was like sweating. I'm like, oh man, he's going to walk away. And he didn't. He sent me the final $10. So
at least you didn't have to meet somebody like in a sketchy alley to swap a USB stick.
Yeah, no, even back then I wasn't doing that.
So I'm not sure if you went to school in the Northeast, but were you involved with kind of like the New Hampshire freedom movement or any of like the local libertarian events that were going on out there?
No, I was down at Villanova in Philadelphia.
Okay.
So pretty far from New Hampshire. And I certainly at the time was not part of any freedom movements, just a dumb college kid on the internet.
Yeah, I was in college during the Great Recession, and the only thing I cared about was seeing my girlfriend and having beers after class. But I do remember in economics, my professor stating like how lucky we were that we got to be in school during the recession because that is like the best place to ride out tumultuous markets. But I didn't come across my first like Bitcoin post until 2012, and then didn't even think about it until 2017. Obviously, the BTC era or the ICO era. So after you bought your first Bitcoin, was that kind of, I mean, you were trading, maybe you paid attention to it as an emerging asset class. Were you still reading news articles? Did Ethereum or the composability of Ethereum or the programmability, was that something that caught your eye, or like what brought you back into the crypto space after your 6 years of trading?
So it was actually a platform called BitShares. I don't know if you remember that one.
No.
It was an early competitor to Ethereum, I would say. It actually launched before Ethereum did. So at the time I discovered BitShares, the Ethereum white paper had come out and I read it. And I was like, wow, that is the biggest bunch of gibberish and nonsense I've ever seen. And I just tossed it aside, forgot about it. And I'm like, BitShares, this is going to be the big thing. And because BitShares at the time was very focused on the user experience. They were not catering to developers. The analogy they used to use is that if Ethereum was this general purpose computer, they were like a Swiss Army knife where they're going to pre-select the tools that you can use, but they're going to be in a blockchain. And the first application that I saw on BitShares was actually and I was a commodities trader at the time, it was a commodity trading application. So it immediately clicked for me because I'm like, wow, I'm paying like 20 to 50% of my revenue every year to the CME for nothing. And I pay 0% to this decentralized exchange. So it immediately clicked. And this was like the first perps on chain. They were called bit assets. And it was actually the first collateralized stablecoin on chain called BitUSD. I'm pretty sure this predates Tether and everything. The only thing that came before that was NewBits, which was a Ponzi scheme like Terra, but just earlier. So yeah, I got into that. I was trading like oil on BitShares and I'm like, all right, a few more years, this is going to take over the whole world. And yeah, I thought it was going to be a very rapid adoption curve because it seemed like it was all there to me. But then I would soon realize that under the hood, it was a lot of shortcuts and it was not ready yet. But then Ethereum launched the Frontier Network, which is their first mainnet. And that's when it clicked for me. And actually, the application that made it click for me at Ethereum was the prediction market, the Augur. I don't know if you remember Augur. I read that white paper and I was like, oh, this makes so much sense. Because before that, I was a trader. I was very interested in these different emerging market technologies. The whole mercantile exchanges where I work, we were all on InTrade because there was a former NYMEX trader called Ron Bernstein who founded InTrade and then went on to work at Augur. So he was kind of like, you probably see a lot of ex-futures traders in there. I think you can credit a lot of that to Ron because he made the jump from InTrade to Augur and he was a trader. So people were watching what he was doing. But when they said like an InTrade that can't get shut down or steal all your money, I'm like, oh, that's brilliant. So it clicked for me there. And then I found other things like MakerDAO, which I'd go on to work with. And yeah, Ethereum just started clicking for me. And I was like, okay, this is going to be big.
Yeah, so let's talk about your transition into MakerDAO. You were the head of BD at MakerDAO. So what was it like back then finding a role in the blockchain space? I think Ethereum was probably the only smart contract platform in town. So how did you kind of make the jump from being a full-time trader into the borrow lend platform that's MakerDAO?
Yeah, there was a couple steps between those 2 points because at the time, like you said, how do you find a role? You didn't find a role. You had to make a role in crypto back then. There were no roles. There were chat rooms filled with engineers. So I first at the time, my boss at the time, then he become my business partner, Joe, we tried to start an ETF that would track the price of Ether. So this is in 2016, we really bought into the Ethereum vision. We saw the Winklevoss twins had their Bitcoin ETF application in. They filed a 19B4, which like you're not supposed to do that unless you have the wink and the nod from the SEC that you're getting approved. So we're like, all right, either they're like going full on to attack the SEC or they're going to get the approval, and who would be dumb enough to go full on against the SEC? And so we're like, let's file our application and we'll make money when Ethereum goes up. So we did that. And then, lo and behold, they get rejected by the SEC and we're like, oh no. So that was a lot of startup capital that went down the drain. But in the interim, we started a crypto venture firm called Distributed Capital. And we did that for a little while.
So when you were preparing your version of the ETF, was this also around the time when you built and launched Ether Index?
That was Ether Index. So
okay, got
Ether
it.
Index was the methodology by which, because at the time, like they didn't have a good way to even track a cryptocurrency for these ETFs.
Right.
That was like, we thought the biggest problem for the SEC was going to be how do you actually calculate a price? So we developed a proprietary index that would do that. But that was obviously not the problem. The problem was that they didn't want crypto ETFs and they had total discretion to reject them for 8 years.
Yeah.
But yeah, it was still a good jump because we got to meet a lot of the early Ethereum founders and community. And we're like, this space is underinvested primarily because TradFi is so hostile to it. So we started one of the first crypto VCs and our agreements allowed us to buy ERC20 tokens. And I think it was us, Blockchain Capital, Polychain, and maybe a little bit Pantera at the time was able to actually buy those things, at least domestically.
And was this like 2016, 2017-ish?
End of 2016, beginning of 2017.
Okay, so you guys got to ride the whole ICO wave.
We caught the first ICO wave, yes. And this is why I said we only did that full time for about a year and a half because we caught it so good. We're like, our investors were mainly New York City TradFi family office types. And we're like, they're never going to ride through a crypto bear market with us. That would be insane. So let's cash them out. And then we will go work at our core portfolio company, which we're really in love with. And that was MakerDAO.
So when you're doing head of BD at MakerDAO, what does that look like in 2017, 2018, 2019? I'm still not convinced that people understand the value of stablecoins. Borrow lend isn't even a thing, really, even if it was like the features were available. So what did those initial conversations look like? What was hitting the ground like when you were going out and speaking with folks?
Well, so the way I get into Maker actually was I was in a chat room on the platform called Rocket Chat at the time. And it was the early Maker DAO. And at the time, it was just that. It was like a DAO. It didn't have any entity, it didn't have bank accounts or anything. And it was just a bunch of engineers building towards the goal of DAI. So I had came in with my business partner and we were like, all right, you seem like you guys could use some business help because you have a lot of engineering talent here, but I think you're going to need like an entity and a bank account to get these things up and running. So we started helping out as consultants and then eventually started working for what will become the Maker Foundation. And we needed job titles. So I got head of biz dev and my partner got head of trading. And the early conversations were with like the first crop of Ethereum founders who would start to build an application on Ethereum and then would find that, okay, my application does not make a lot of sense because it's financial if you have to use Ether as the unit of account. So look at like Augur was one of our early integrations. So you go to Augur and you're going to make a bet on the outcome of a presidential election or something, right? And you're buying an asset for 50 cents, but there's hundreds of percentage points of volatility baked into the underlying asset that you're making the bet. You could win the bet and lose all your money. It didn't make any sense. So even the early developers understood the value of a stablecoin. I would say no one, including me at the time, really understood what a stablecoin needed to be to scale. Because Maker's model was to replicate a commercial bank on chain. So basically have credit creation. And that was predicated on the belief, which I will challenge anybody who tries to be a Monday morning quarterback here. Like we thought everything was going on chain. Everyone involved at that point in time did. We thought companies were going to IPO on chain. We thought tokens were going to be the next valuable asset class. Like we did not think that the credit creation side would constrain adoption. We thought that the integration side would constrain adoption. So like at the beginning with Maker, you could just create DAI against ETH, but we're like, there's more than enough credit demand against ETH to facilitate the next 5 years of DAI adoption. And we were extremely wrong about that. But yeah, that was the initial conversations. Integration made sense. Nobody questioned whether you can create enough DAI to matter, and nobody questioned the composition of the stablecoin, which we should have.
So I got into the blockchain space. I was hooked almost immediately in summer of 17. And the vision back then was just as you painted. Everything's coming on chain, like Uber's going to be decentralized. Everything was going to be decentralized. And here we are, mid 2025. And a lot of those visions just have not come to fruition. A pervasive trend last year was quiet quitting amongst people who've been in the space for 6+ years. So maybe like a sidestep, I understand, but like what keeps you motivated to keep working in this space after so long when it's so easy to get jaded?
Well, I definitely got jaded, but I feel like I've always had more realistic expectations than most. Like I never understood why we built so much infrastructure that people don't use. And I've always been focused on applications that will impact the end consumer. And I think in terms of like whether the technology can produce that outcome, it absolutely can. But you have to we went from like, okay, let's bring financial institutions on chain, disintermediate this, disintermediate that, to we're going to tokenize and decentralize Uber in like a year. But it didn't start like we're going to tokenize, decentralize Uber. It was more like, oh, maybe capital formation for companies like Uber will happen on the blockchain because there's a better decentralized model. Like it started grounded in reality and then very quickly just got blown out of proportion. But I think if you continue to ground yourself in reality, you see that this technology is extremely impactful to the consumer. Especially like the best example I give every time, I've been doing this for, I guess, like almost 10 years now of giving this example, is like go to a bank and send a wire transfer. And tell me you didn't just feel like you went to the DMV because you feel like you are interacting with a government employee that has absolutely no incentive to serve your interests, because that is the worst system you will ever interact with. And then go and take a stable coin and send it to anyone you want in the world and tell me you didn't just see yourself in the future.
I think we're also starting to see that now with like a lot of these US treasuries coming on chain. For anybody who's ever switched a job, like migrate your 401k from one employer to the next. And it's a 4 to 6 week process dealing with cut paper checks. And in between transit, you have no idea where your funds are. If you've been at a company for 20 years, it's like 6 figures that's just floating in the ether and you have no idea what's going on. And this is a very real use case today that on-chain transactions can kind of provide some solace for people. They can see where their assets are and they can track them and own them. So zooming back to your background before we catch up to today, in between MakerDAO and your time at M0, you also co-founded Ajna Labs, which was a permissionless borrow lend platform. And from what I was able to take away from my research, you were essentially like trying to work yourself out of a job from day one by making the protocol be permissionless. So what was like the timeline for Ajna Labs, and what was the process like getting this thing up and going and then stepping away from it and letting it be its own thing?
Yeah, so you're dead right about the intention of Ajna. Like we were really looking at Uniswap because we found them very inspirational in what they did. And we wanted to create a protocol that could exist without any dependencies. And our belief was that if you built that, then other people would come to build their own applications on top, appreciating the stability that offered to them. And so obviously Ajna does not have a lot of TVL today. It started off very strong and then kind of faded. And it's still around. We're still doing integrations and there's some UX improvements coming up for Ajna that can hopefully bring it back to a growth path. But the key issue with Ajna was that, in my opinion, we optimized for that decentralization and that permissionlessness, where that like just didn't end up being what the market cared about. The market cares about simplicity of user experience. Like people do not want to figure out how to use something. They want to click a button and they want it to work. And with a completely permissionless protocol, you need someone to do that for you. Like you need an orchestrator. And those orchestrators don't just come out of thin air and produce themselves. You need to incentivize them. So there was like Ajna started as this idea of like, we're going to optimize around total decentralization. We actually achieved it, but the end product of achieving that was very difficult to use unless you had someone orchestrating a front end that would automate a lot of the functions. Funny enough, what could bring Ajna back is LLMs. Because you can tell an LLM your intention of what you want to do with the protocol and it can just generate the transaction. I don't think like Wayfinder or these other LLM-based wallets are quite there yet to interact with a protocol like Ajna. But when they do, I could definitely see it making a comeback, because the specialty of Ajna is it can ingest assets that don't have oracles. And like when you first launch an asset onto the blockchain, and this was the other problem with Ajna, like we launched at the peak of the previous bull market essentially. And we had a lot of borrowers because there was value in this concept of like, okay, this asset has no agreed upon price source, but there is borrow and lend demand against it. And there's people that have good equity in these assets that want to capture it. They all got wrecked because all their assets went to zero. So it wasn't really like Ajna didn't find product market fit out the gate. It's like it found product market fit, but then all of the integrators just lost all their equity and walked away. And then you would have to go get new ones.
Yeah, at that time, that's kind of like a double-edged sword and what's going to kill your protocol. Launching at the top of a bull market, you just don't get the chance to build fat of developers and users as you grind up that way. And everybody was doing borrow lend. And then like when Terra collapsed, like there also went the kind of proper narrative or just incentive for anybody to want to explore this. And I just read an article this week about how DeFi, for the first time, decentralized borrow lend platforms are actually starting to increase in volume again, as well as through CeFi. So this is what, 2.5, 3 years after the collapse of Terra and FTX. So yeah, I mean, it's been a couple of years since that use case was kind of highly sought after. I'm picking up some really interesting themes in your time at MakerDAO and what the issues were with increasing adoption and use for DAI, as well as at Ajna in terms of prioritizing decentralization and not necessarily meeting the market where they wanted. So using these kind of like lessons learned over the years and finding out what your constraints are, how are you able to apply the things that you recognize didn't work at your previous ventures? And what are you doing now at M0 to offer programmable stablecoin issuance infrastructure, leveraging those lessons that you've learned firsthand over the years?
Yeah, and I wouldn't say like MakerDAO didn't work. It's still around. They have like $10 billion of TVL, but
well, and they're deploying billions of dollars into like on-chain MMFs.
Yeah, I think the better question to ask is, were those designs built to scale to the mass market?
Okay.
I don't think so. I think that's the problem. So Ajna was simple. At its core, it could be applied to the mass market, but it needs that incentivized layer built on top. I think it's a bit of a different problem than Maker has. Maker was actually very much built from the outside to hit the direct market. But on the back end, that's where we ran into problems. And like specifically around how to bridge the off-chain and on-chain worlds without exposing that to the user. That's what M0 solves. So M0, you could think of it like a complexity abstraction machine. On the one end, for people who want to build stablecoins, it abstracts away all of the complexity of off-chain collateral management, yield collection, compliance, et cetera, and just delivers a wholesale asset called M that you can then integrate completely on-chain to make your own stablecoin, or what we call an extension. On the other side of the protocol are the issuers and the compliance and the regulation, the licensing, et cetera. And the protocol manages all of that on the other side. So we keep that away from the user and everything's intermediated through M.
Cool. I want to delve into M in a little bit, but first, if we're like going skydiving, let's pull the parachute first and kind of do the broader kind of like stablecoin place we're at right now in regards to the outlook on stablecoins. So where does M0 fit in the broader stablecoin market? And really, as we start to see more centralized entities use like fiat-backed stablecoins, where does M0 fit in terms of like Circle's getting bigger and Tether's getting bigger and other similar competitors?
I think we should even go a step higher and ask, like, what does the consumer want out of a stablecoin? Because from their perspective, these are all the same thing, right? Like they just see stablecoin, they think they're the same, but as they are constructed very differently under the hood. And that construction does matter at scale. So I think what the consumer wants is that they're yearning for cash. If you think back, like pretend that we're sitting here 50 years ago, we are not going to the store and spending our bank deposits like we do today. We're going and we're spending cash. And cash had a lot of very nice properties that we've lost in the transition to digital. And so in order to make everything digital, we just basically digitize bank deposits. And bank deposits are very far from being a perfect substitute for cash. They have counterparty risk. They're not fungible. They have to clear. They have all sorts of weird compliance issues that make them hard to use as a payment instrument. So Obviously, we've bolted on some things on top, like credit card networks and stuff that dramatically improve the user experience. But what we're seeing, and this is proven in the demand charts, like people want those properties of cash again. That they want that instant peer-to-peer payment that they can keep in a wallet, self-custody, not take counterparty risk, and basically just have that old experience that they used to have back.
So from your perspective, it could be an over-collateralized stablecoin or even one of these US debt instrument-backed stablecoins that really takes off. It really just matters what is easiest for the consumer to purchase things with.
Well, yes and no. I mean, like I said, the consumer doesn't care. The consumer cares that whatever they're using meets their needs. What you just described could never meet their needs. So first of all, every stablecoin is over-collateralized. It's a misnomer to say that Tether is not over-collateralized and DAI is. Like, I think what you mean to say is crypto-collateralized. So there's this idea that you could collateralize a stablecoin with only on-chain assets. And maybe we will get there one day, but it very much matters what those assets are. And the answer emphatically is no, you cannot have a stablecoin collateralized by volatile crypto assets. The only crypto assets that you can properly collateralize a stablecoin with are tokenized T-bills or tokenized money market funds or something else that has almost zero volatility against the dollar because nothing else will scale. And this is why I'm actually quite pleased. I usually am very against regulation, but I'm quite pleased with the stablecoin regulation because all they do is just define a stablecoin. It'll stop so much strife in the consumer market because like people are just going to keep getting ripped off if you market something as a stablecoin and it gets conflated with actual high quality assets.
So maybe then we can kind of like start there then. What is your outlook on the Stable Act and the Genius Act, both of which are going through the two different houses of Congress? What are the pros and cons beyond just giving a basic definition? I mean, to me, it's kind of convoluted. There's two different acts going through two different parts of Congress. There's nuances in both. There's a pressure to get one of these bills put through soon. Maybe there's going to be a combination of both. It's really confusing right now for anyone who's not like really paying attention to this day in and day out.
Yes. So first of all, they're very similar. And at the end of the day, the differences are maybe 2% of the language is different. I strongly prefer the Genius Act over the House's stablecoin bill. And that's for two reasons. One is that the Genius Act has effectively hard-coded bankruptcy protections in for stablecoin holders. This is an issue that's very hard to explain to the average consumer, which is that you really need bankruptcy protections on any asset you hold. And what that means is not like, oh, am I going to get ripped off in a bankruptcy? No, you're not. Like chances are, if you, like, let's use Circle as an example. So Circle today is regulated as a money transmitter. If they were to declare bankruptcy, I'm sure that all the assets are there, right? Like they're not doing anything weird with them. But that doesn't mean that you don't then have to go through a bankruptcy proceeding and those assets are going to be held up in bankruptcy court for 2.5 years to 3 years. And like that would be for a stable coin that promises instant creations and redemptions. And like that's its value proposition, that it can facilitate global finance. A bankruptcy where all of the backing assets get frozen effectively for years, even if they are there. And then you have to worry about like lawyers eating into those assets. That's just a bad system, right? Like that's not sustainable. And I think it's hard for the average consumer to appreciate that because they don't see a lot of bankruptcies. But to anyone who's seen a bankruptcy, especially crypto people who have like seen the FTX bankruptcy and how absolutely F they got out of that, or the Mt. Gox bankruptcy, they know it's like, if you don't structure these things correctly, it doesn't matter how good operationally the company is, like you're not going to get a good outcome. So hard coding bankruptcy protections is, to me, single-handedly the most important thing the regulators can do, because that's just something there's no other way to structure. Like what we do today is we use bankruptcy remote entities, but then it causes a lot of complications fitting into the existing licensing regimes. So this gives us an extremely clear path to launch issuers in the US without having to compromise on the quality of the stablecoins that we issue.
Are there any other key differentiations between Genius and Stable?
How prescriptive they are about yield-bearing assets. So, and I think it's way more nuanced than people think. So when people hear yield-bearing stablecoin, they think, okay, it's going to earn a savings rate for me, like holding a T-bill, right? Very few stablecoin issuers want to do that. And even the ones that do it haven't seen a lot of traction. The real issue here is that the way that the House wrote the language, it potentially jeopardizes distribution agreements. So I'll use Circle again as an example because they're like the biggest domestic issuer we can find. So Circle today has a big distribution partner called Coinbase. And they pay Coinbase to do that. But Coinbase is actually the holder of the stablecoin. If you look at the wallets, like they all belong to Coinbase. They don't belong to the users. And the users are then unsecured creditors to Coinbase. So in the House language, it says you can't pay yield or anything like it to a holder of your stablecoin. Whereas the Genius Act is much less prescriptive, and it just says like yield-bearing stablecoins, if they're securities, are going to have to be regulated as securities, that's the law already. It's almost redundant to say it. So you're not going to see people holding yield-bearing instruments, but we also don't want the House language because that would break potentially it would just cause a lot of frivolous litigation because these distribution agreements are the right way to operate. There's nothing wrong with them. There's nothing harming consumers. I mean, even a yield-bearing stablecoin wouldn't harm a consumer, but that's a different topic. But my point is it doesn't interfere with the banking lobbies that are trying to prevent this. They just wrote the language wrong. So essentially, I'm hoping the Genius Act is the one that gets pushed through. But like I said, the points are really nuanced. They seem really minor, but in aggregate, they really affect back-end service providers like us.
I've been reading between the lines for what's going on in DC. And currently you have in these conversations, Circle pit against Tether. But quietly and increasingly so this year, you have entities like Bank of America stating they want to come in and provide their own stable coins. So maybe this is tinfoil hatty, but is there a world where there's a circus show of Circle versus Tether where quietly in the background we have banking lobbyists pushing for them to become the stablecoin providers de facto in the US?
Yes and no. I mean, they're going to push the lobbyists, but they're not going to succeed. I mean, you've obviously been exposed to banks for quite some time now, and I think the pace at which they innovate. Our position as a stablecoin startup is that, one, don't regulate around the business model of Circle and Tether, because that will very quickly get outdated. Also, don't push us back to the Stone Age and force us into a banking model like Mika did. That would be the worst outcome. But fortunately, the legislators have been much smarter than that. They haven't listened to the bank lobby. They haven't over-optimized for Circle and Tether. And if they pass Genius as it is today, they will have really, in my opinion, succeeded in passing good legislation. But our opinion is that Circle and Tether, we think of them like the Nokia and BlackBerry of stablecoins. Like, they're huge today. They have proven a market, but there is just no way that's the model we land up. And like, I can give you a very simple anecdote for why. So these are two actors that could potentially be issuing the entire global money supply. Do you see that as a possible outcome that anybody could live with? No, right? Two centralized private companies issuing the entire world's money supply. Nope, not going to happen. So we think that if you want to create the Apple or the Google of stablecoins, you have to not be too restrictive in the regulation that you put out there. But like your argument that a bank is going to come in and do this, to me, that would be like saying, okay, well, IBM is going to build the next smartphone after a Nokia and BlackBerry. Like, no, they are just out of the race. If you want to look at who gets hurt by this whole stablecoin movement, it's banks. And if you want to know who deserves to get hurt, it's banks, because they're terrible.
Yeah, I 100% agree. And honestly, like, thank you for painting that picture, because it was hard for me to see the other side of the coin when you have your doomer hat on. Have you had a chance to be invited to DC to be a part of these conversations?
I've been invited to a couple.
Okay, cool. Perfect. So another kind of, I guess, I wouldn't say competitor, but maybe market entrant would be these state-based stablecoins. And so like you look at Wyoming, they're talking about having their own state-based stablecoin. And they're even using some like really nice language where portions of interest will go to the state's education system. So what's kind of like the status or the chance for states to kind of compete in the space and grab a slice of the market share?
I'm going to be honest, I love seeing the experimentation. It's very cool. I think they have absolutely no chance of being commercially successful, but it's for a simple reason. Like, everything tries to get as close to the consumer as possible. This is just universal, right? And the state is not very close to the consumer unless you're talking about tax payments. And most states don't even have income taxes, especially the ones where they're experimenting with stablecoins. So I think what we're betting on at M0 is that the distributors of stablecoins ultimately want to become the issuers of stablecoins, or at least we call them extenders, because they're not legally issuers, they're just distributing, but they want to have the control over the asset. And that's what we're optimizing for. So we think that if you look today, like Circle and Tether, they issue the stablecoins. They don't distribute them. The exchanges and the market makers distribute those assets. And we see a future where those exchanges and market makers all want to have more control and also retain the economics over that issuance. In our opinion, they're going to be the winners.
If you looked at Circle's IPO paperwork. They just showed how much money Coinbase made in fees from issuing or distributing USDC.
And in my opinion, they don't pay them enough because they do all the work. So.
Yeah, and also another point that you brought up regarding state stablecoins, like that's a great point. Most people don't want to use crypto, even if it's stablecoins, to pay for their taxes that they do have. In 2023, Colorado made it possible for residents to pay their state income taxes with crypto. And in 2023 and 2024, less than 80 people in general, for less than $70,000 in aggregate, paid for their state income taxes using crypto. We don't want to let it go. So I appreciate that insight.
But it's good experimentation, right? Because what they can do now is they can optimize their own regulations to attract issuers. Because what Genius does is it says, if you get to a certain size, you're federally regulated. But if you're under that, you're state regulated, which gives startups really the ability now to go to all the different states and say, hey, who's going to treat me the best? And now those states could be competitive on treating them the best.
Have you guys had to shop for different states to work out of like this, or?
No, we are currently offshore. We don't have a U.S. issuer. We're working on it. I don't want to leak too much alpha here, but you might see some announcements really soon. But we are a multi-issuer stablecoin. So we don't, if we do onboard U.S. issuers, they're not going to be controlled by our company. They're going to be their own independent licensed entities that are joining our network.
So before we kind of delve into that, I just want to briefly talk about the choices of networks that stablecoin issuers are operating on top of. So again, the current market cap in late April 2025 for stablecoins is $227 billion, and $126.5 billion are on Ethereum, $68.8 billion are on Tron, and $12 billion are on Solana, and then the rest is split amongst 10 different chains. Why are all these stablecoins landing on Ethereum, and what does the race for different blockchain networks look like now? How do different blockchain networks compete to land stablecoins?
Now, I feel like you found one of my trigger points into tricking me into going on a rant or something.
Please rant on.
I'm sure are you a follower of crypto Twitter? You follow all these talking heads that just opine all day?
I'm unfortunately on crypto Twitter all day long.
So you've probably noticed that the new thing is arguing over whose chain's the best, right? And is Ethereum going to zero? Did it optimize for this correctly? Blah, blah, blah. Right? But I just want to let this secret out to the world. Is this a family-friendly show? Can we curse on here? Or is this
curse if you want to.
No one gives a shit. Truly. No one outside of this stupid little bubble that we have cares at all about which blockchain you're running on. They don't care if it's decentralized. They don't care if it's permissionless. They don't care if it has rollups or blobs or anything. They just care that they can use it. And the reason you're seeing Solana take off and not Ethereum in a lot of respects is nothing to do with design choices. It's because Solana really went for the direct to consumer stuff. But even there's a lot of trade-offs and everything's ripe for disruption. It's only the network that is hitting the consumer that people care about. So I think from an application developer standpoint, we want to be everywhere because we also don't care. We care about consumers. We want to make money. We want to serve people. We want to actually make an impact. We're just not going to make trade-offs for no reason. So
awesome. I love it then. So let's zoom into M0 then in particular. How do you guys choose which chains to operate on? Obviously, there have to be users there and there has to be demand. Is it developer metrics? Is it unique wallet addresses? Is it what your partners are working on top of? How does this go about?
It's where the users are. And for us, a user is an extender. So this is a business that wants to launch their own stablecoin. So wherever those application builders are, that's where we go. And today we're on Ethereum, we're on Solana, and we're about to be on a few other chains. It's entirely demand driven. We don't guess at all. We wait until we have a customer on that chain, and then we build the integration to go there. And I feel actually now that I went in my rant, I have to backtrack one thing. So there are certain applications where having censorship resistance and credible neutrality are very important. For instance, we have a governance layer in our system, and I think it's very important that is built on a chain that has very high security, very high credible neutrality and censorship resistance. But just to deliver assets to the end customer, which is where we're using this TVL metric that's almost meaningless, that doesn't matter. It just matters where the applications are. And applications are going to go not based on pure, they have a huge trade-off matrix. Sometimes decentralization and censorship resistance is going to be the thing they need. But other times the chain can look a lot more like an AWS database that it's fine. As long as it's not literally an AWS database, they're probably, a lot of consumer-facing applications are probably fine with that level of centralization. So I think you're just going to see a lot more diversity in these environments than we originally anticipated.
Interesting. So for the governance purposes then, to vote on M0 governance, you have to use power tokens. So did you guys end up building on top of Ethereum then because that's the most distributed platform?
Yes. I mean, we built it on top of Ethereum. I think the EVM has the level of expressiveness that we needed for the application. But also, if it was today, the choice would be between Ethereum, Solana, Sui, one of these major chains that has a good level of distribution of nodes, I'd say. I don't even research this stuff that much anymore because I'm so deep in the application layer. But if I was starting the process over and I had to say, what am I looking for? I just want to know that the chain can't be arbitrarily controlled by a single person. That's probably the most important thing. Do they have any incentive to try and capture my app? If not, then it's probably a contender. And then we're going to look at the programming languages and the virtual machine and like what you can and can't do at a token level.
Do you have preferred programming languages?
It would have made my life a lot easier if everything was written in Solidity because that's what we wrote everything in the first place. But we recently rewrote the whole protocol or the parts of it that we needed to port over into Rust for the SVM. So we're deployed on Solana now, and that's been really an exciting journey because we're seeing a ton of demand out of Solana. It feels like a very underserved stablecoin market, and we're happy to be there because it's where a lot of our business is coming from. And it has some really cool features. Like it's very fast.
So maybe we can delve into that a little bit then. You guys just announced this month that your first user will be Cast, a platform offering banking-like services using stablecoins.
First user on Solana.
On Solana, correct. Sorry. So how did this partnership come about? And what exactly did you build for or alongside Cast?
So we built an extension for Cast, and an extension is a wrapped version of our M stablecoin where the builder, so Cast in this case, gets to control the compliance, the yield distribution, the other features that you may want to bake into the smart contract, et cetera.
What are some of the considerations for compliance that an extender might want to take into consideration?
Everybody has different views and obligations, obviously, depending on what they're doing. We're really trying to innovate here and to get away from this monolithic model of like, okay, Circle issues a stablecoin. They're the issuer, they're the distributor, they're the compliance maintainer, et cetera, right? We think that should actually be much more modular and specialized service providers should step in to do their jobs. So one thing we're working on is outsourced compliance functionality. So a common compliance feature you see in stablecoins is the pause method or the blacklist method. So if you have somebody that's not supposed to be holding it or a government issues a subpoena, you need to freeze the assets. And like this is basically getting baked into legislation worldwide. It's a matter of time until every stablecoin needs to comply with that. We want to use third parties for that though. Like we think that there is very sophisticated third parties out there like chain analysis and TRM and stuff, and people like them who you can just give them, let's call a hook, like kind of like Uniswap V4 has these hooks into the smart contracts. You can give them a hook into your stablecoin and they can effectively run that program for you. So they could say, look, we're going to just do global maintenance. And if you get a subpoena forwarded to us, we'll freeze the address.
Got it. Okay. So M is kind of like the powerhouse that is used for a lot of these extensions.
It's the wholesale asset. Think of it like wholesale and retail. So the extenders are the retail distributors. M is the wholesale asset they buy from the manufacturer.
So your partner would buy 100,000, 1 million M at a time.
Yeah, I think our average chunk is like 1 million. That's what we say.
And I'm probably going to chop this up. And so correct me wherever I'm wrong. When they're using M, they're essentially basing their token on M for its stability.
They're using M as complexity abstraction, which is the best way to put it. So they're relying on M, yes, for stability. They know they can always, at least in the wholesale market, redeem M for $1. They are using it to automate yield collection. So the protocol collects yield from the series of issuers that's set up top and redistributes that yield down to the integrators where they can then do what they want with it. They're relying on it for transparency. So we have a network of validators that are every 24 hours providing a live proof of reserve for every issuer. Otherwise, they can't be part of the protocol anymore. So yeah, they basically rely on us to do all of the stuff that you don't want to do as a stablecoin distributor without having to give up all of the economics like they currently do to Circle and Tether.
Can you share a little bit about the considerations that go into a multi-chain M issuance? Because now you're on Solana, you're dealing with SVM, you're dealing with EVM chains. Isn't Noble built on CosmWasm? Or so now you're in 3 different ecosystems. What's the complexity in that? Like you're earning or you're capturing yield from different issuers on different blockchain networks. Is there like a multi-chain pool that all of this yield goes into? That it's
You got it a bit backwards. So the extenders are like, think of it like an hourglass. So up top, you have the issuers of M. They all funnel into the protocol. And then outwards comes the extenders. These are the distributors. So like Cast is an extender. They're not an issuer. So the issuance is happening really at a very high level, very far away from the extenders. That boils down to M. We then propagate M around all these environments. So, and this goes down to just like the basic, it's like that meme, like it's multi-sigs all the way down. So we have multi-sigs that control the various portals on the different chains. And we have custom security setups to make sure that those can't be compromised. And then for message passing between chains, we currently use Wormhole, and we're integrating Hyperlane for places Wormhole doesn't support.
cool. So what are some other, once you've integrated into an ecosystem, do you double down on finding partners there? Or are you more of like a first principles, we're just going to go where the users are and it doesn't matter?
We don't go anywhere without a partner. So we deploy once we have a signed extension agreement where someone's basically hiring us to build them an extension, and they've demonstrated enough of a business case where we could justify having to do the deployment.
Okay, so now you have, according to the dashboard, you have Noble, Usual, and then you have your M token. So you have extensions. Collateral is up and to the right since the launch in June 2024. What does the pipeline look like now? How are you guys being inundated with potential partners? Are you still kind of on a partner by partner basis? Are you still kind of fielding individual calls at a time? Is demand starting to swell up? What does this look like?
So we have a very strong pipeline of extensions now. And that's really like our success benchmark. We build a lot of infrastructure too. So we're building specialty liquidity stuff because it's all about serving these extensions and making sure that they have a great experience. But in terms of how many extensions we're going to build, I think we have like 5 or 6 in the pipeline right now, and that's growing every day. And this is all word of mouth. We haven't even done any marketing yet, which we're going to do. So we're hoping that it really starts to explode. One thing that we're building so that people can do this more easily, because right now we can only produce like 2 of these a month for partners. We're building a self-serve product. So this is where developers can come in and they could just follow a set of instructions and pre-audited, pre-compiled code, and they can deploy their own extension.
So it'll be like CCIP in that way, where there's a SDK available and developers can choose to kind of like tap into, for all lack of better words, the M0 network.
Yeah. They're basically opting into using M as the collateral for their stablecoin. And once they do that, the real gating factor for them is getting on our earner list. So governance maintains an earner list of extensions. If you could still create an extension without being on the earner list, but you're not going to be able to collect any yield then. And if you're not collecting any yield, you're probably just going to use a different partner. So that's how we gate access and we enforce these standards. Like we basically say, well, you need to use our audited code or we're not going to put you on this list.
And so a lot of your partners, are they seemingly right now crypto native? I mean, you look like Noble and Usual M. These aren't like screaming institutional people. Are you starting to like see the breadth of potential partners expand beyond like crypto natives to like TradFi or anything like this? Or is it still a little too early in the game?
Yeah, we're seeing it slowly happen. So this is just a matter of what we're good at versus what our competitors are good at. Like, we're not great at pitching legacy financial institutions because we're a very tech-focused company. Like, everything we do is crypto native, everything's on chain. That pitch doesn't yet resonate with the Fidelity or somebody. Like, they're not going to care about that. They're going to be like, go show me your most centralized setup and show me the 9 licenses that it has. Like, they don't really care about interchain connectivity and Uniswap liquidity and things like that. Whereas the crypto native firms, they understand that very well, and it's a huge competitive advantage for them. So they go with us. But we're seeing it expand. Like, now I think we just signed a gaming partner, which is pretty cool. That announcement should come out pretty soon. And we are going to start approaching fintech, just probably not the fintechs you think of when you hear the name, because those big almost legacy institutions now, like, look, PayPal's a perfect example, right? Like, they went with Paxos, they have PYUSD. It doesn't really do anything, right? Like, it's just a stable coin to have a stable coin that's backed by their muscle and their balance sheet. Like, we find that the integrators we go with are actually doing something meaningful with the stable coin, where they want to integrate it in a way that it gives them a competitive advantage. They're not just doing it to have a stable coin.
So you just mentioned competitors. Who would be like your closest competitor today that somebody listening to this podcast might know?
We find ourselves in the same conversations as Paxos quite often. But it's funny because we almost never find ourselves in like a head-to-head with them. It always diverges very early. It's like, okay, there's some sort of legacy fintech, highly regulated institution, they're probably going to go Paxos. There's some crypto native, like really innovative, fast growing startup, they're probably going to go M0.
Yeah, if I'm reading between the lines, to join the Paxos network, they want like the Visas and the Krakens and these big names that they can get a lot of users and share the yields between the partners in their network, not necessarily with the token holders. So are you finding that M0 does help distribute the yields more in a more egalitarian manner than necessarily just to like your issuing partners or your extending partners?
Not necessarily. We distribute it to the partner, right? Like it's up to the partner what they do with that yield. Now, a lot of them are much closer to the user, so maybe they're going to find a way to incentivize them to hold the token. But I don't think in the long run, you see people just holding these things like savings accounts. Like people had access to savings accounts. Maybe if you're in a different country, then sure, that might be a big product. But I think you need to offer some sort of additional functionality on top of that. Like Cast is a great example. Cast uses it partially as a savings account. So they pass some yield onto their international users. But then they also give you this excellent, I mean, I've used it myself now for quite a while, this excellent off-ramping experience where if you have a Cast card, like you go anywhere in the world and you can spend like it's just a normal credit card. So that to me was a huge unlock. I use it around the block at the store now.
Cool. Very cool. So kind of zooming out and wrapping up, in April of this year, Standard Chartered predicted that the stablecoin market cap would reach $2 trillion by 2028. What's just your general thesis for how prevalent stablecoins are going to become in the everyday person's life and not just your crypto native?
Everyone will be using stablecoins for almost every transaction that they make. And they will be blissfully unaware of that fact because it'll be completely baked into the back end of the applications they use. Their lives are just going to get better because instead of going to the bank and having to send a wire transfer, they'll be able to click a few buttons.
So maybe I can draw a spicy take out of you then. How long do you think it will be until we reach that point? Is it 2 years? Is it 7 years? Is it 15?
I think closer to 5. So
Okay.
I say that because we will reach the tech-forward consumers in the next 2 years. That we're very on track to do. To reach like, our parents, you need to get integrated into the big players. Like they're not going to go download a new app and try something. Like it has to be integrated into their existing applications, which are very few. And those guys just have very long integration cycles. Like if you started now integrating into JP Morgan Chase, like that you might get that launched in 5 years.
We've covered a lot of territory today, and I'm almost positive that there are questions or things that I missed. So is there anything that you feel like is also important to mention that I didn't quite draw out of the conversation?
Let me think. So I think that the macro environment is the other factor that doesn't get addressed very often. Like we've all kind of now taken it for granted that we're just going to dollarize the world with these things and it's going to be very good for the US, which I still agree with. But that is contingent on people still wanting to use the US dollar for trade and such. So I think like we're in a bit of uncharted territory here because that's getting shaken up a bit. But right now we see like a question I always get asked and I always answer the same way is, are you guys going to make a stable coin that tracks the euro or tracks the yen or I don't think it's even possible to do a Chinese currency, but if you could, would you do it? Right now we see zero demand. Like literally zero. No, everyone wants dollars. And as far as I can tell, that's how it's going to be for the foreseeable future.
So you're not concerned, because right now at the time of recording, we're in the midst of these tariffs and trade wars. Gold is surpassing all-time highs. The Dixie index is down. 30-year bond rates are going up. There's a lot of short-term fragility in people's outlook on the dollar. Are you feeling a bit unflappable about what's happening right now? Like this is just a short-term blip?
I think it will take a lot to get like the average person to care enough about whatever volatility this introduces into the dollar. Like, sure, maybe at the high political level this matters, but when you are talking about receiving a payment, a dollar is still a dollar. So I think for the foreseeable future, this is going to be a completely dollar-based industry.
Yeah, I haven't looked up the numbers yet, but I gave a presentation on stablecoins maybe about 9 months ago, and 99.1% of all demand for any stablecoin was dollars. And then maybe euro, maybe was the rest of that 0.8.
Yeah, I think the euro number is going to continue to decline as long as they have MiCA in place, because MiCA is one of the worst pieces of legislation ever passed.
So what's next on the roadmap then? You kind of teased out some partnerships. You mentioned gaming. What's something that you're looking forward to in the next quarter or two?
Well, like I said, we have a lot more extensions launching. So I'm excited for our next explosion of extension integrators because there's some really cool brands in there. But otherwise, we're really trying to rein in and make coherent our infrastructure liquidity vision. We're building some really cool things. Like we have some new Uni v4 hooks that are in audit right now that are going to launch, and we're going to use those to amplify M liquidity on chain. We have a bunch of other chain deployments coming in that are really cool. Like we have the Solana deployment, and then we're going to have some other ones coming up that we're accessing through a variety of bridge partners. So yeah, I think we're doing a lot, that's for sure.
Super cool. So if anyone's listening to this, who do you want to talk to and what's the best way they can follow you or what's going on with M0?
We want to talk to anybody with distribution power that feels they could benefit from their own stablecoin. Whether you have one today or whether you're using Circle or Tether, or you even want to just think about having one, we want to talk to you. They can reach us in almost any way. They can reach out to me directly. I'm probably most easily reached on Twitter. My handle is G_DIP. But we have a LinkedIn. You could reach out to the LinkedIn page. It's just M0. We have a Twitter, M0 Foundation, and a bunch of other channels. Our website's m0.org, and there's also an intake form there.
And a really cool dashboard. Greg, thank you so much for taking the time to chat to us. It was super fun to kind of delve into your background. You don't don the OG hat, but you certainly talk the OG talk. So thanks for sharing your lessons learned, a lot of the really great things that you're working on at M0, your perspective on the stablecoin race here and abroad. And I really appreciate it. It's great to chat with you.
Thanks, Don. Appreciate it.
Cheers. Thank you for tuning in to the Smart Economy podcast. To stay in the loop with all our latest episodes and insights, head over to www.smarteconomypodcast.com. And don't forget to subscribe to our YouTube channel for all of our video content. If you enjoyed today's discussion, please consider showing your support by liking, commenting, and reviewing this episode on your favorite podcasting platform. Your feedback helps us reach more listeners and brings even better content your way. We'd also love to hear from you, so please drop a comment on Spotify or YouTube to share what topics you'd like us to cover or who you'd like to see as our next guest. And if you or someone else you know would make a great guest, please reach out. We're always looking for fresh voices and new perspectives. And if you're a NEO token holder, please consider voting for NEO News Today as your council representative. We've proudly been serving the NEO ecosystem since 2017. We'll continue to do so by putting portions of our council rewards directly back into ecosystem growth initiatives. So, thanks again for listening to the Smart Economy podcast, and we look forward to catching you next time.